watching BloombergQuint. Now, is India's real estate sector decidedly on the mend? The news on the home sales front is very positive. CRISIL says there's been a surprise surge in key markets when it comes to home buying. But the picture is not so clear on the commercial real estate front. On Talking Point today, we have Prestige Estates' Irfan Razack to talk about the outlook on both aspects of the real estate market, as well as the over 9,000 crore rupee deal that Prestige has just signed with Blackstone. Good morning, Mr. Razack. Thank you very much for your time here today on BloombergQuint.
Good morning, Minaka.
Well, thanks, sir. October's been a good month according to CRISIL, sir, and that's the feedback we're getting across the board. I think the sales when it comes to homes or residential units in many key markets, including in Mumbai, have actually exceeded the kind of sales figures that we saw in the early part of the year pre-pandemic, which is January. How would you qualify this recovery in the residential market? And is it as robust across many of the other cities that you operate in?
Yes, actually, it's quite a happy sign for us. The residential sales are not only before the pandemic, it's better than even the last year when things were on a peak. So I think October, November, going forward, maybe even December will do extremely well. And reasons are two reasons. One thing is the interest rates are at an all-time low. And that is giving people an incentive to commit themselves and buy. And the second thing is the product on offer. There is a choice, number one. Then the second thing is the pricing is also pretty reasonable. It hasn't gone up too high and people can still afford to buy. But having said that, it's just not in the affordable or the mid segment that the sales are happening. It's happening across the board. It's happening in the luxury sector. It's happening under construction properties, also under ready homes. Another thing, I think people have realized that it's time for them to upgrade themselves. They've seen themselves in lockdown. Maybe they want a bigger home. People who are in an apartment would like to move into a villa. So that sort of a movement is happening. And I think it's happening across the board. It's happening in Bangalore. It's happening in Hyderabad. Chennai is also doing pretty decent sales, and so also in Kochi. And then there's a lot of buying from NRIs. Even they are committing, finally, probably if they feel that let's have a place called home in our own country. So even they are also committing themselves. And all in all, I think it's a good momentum. And as long as that lasts and as long as we are able to get the right momentum, I think we are happy. At the same time, the disclaimer is that the virus hasn't gone anywhere. The stress is there in the system, and we should be careful. And the only other part is we need to also know how to see that the goods that we have sold, they are produced, they are delivered to the customer in the type of range and the quality that we've agreed to. So these are some of the issues that we face constantly. And I think while we have to be happy about it, we also have to be quite conscious and cautious both to see that we deliver what we promise. Yes.
I take that point well, Mr. Razack. But, can you talk me through any change in the home buyer profile that you might be witnessing, whether they're all only looking for ready inventory, or are you seeing some confidence return in pre-booking that's under construction sites as well? That gives us a sense of, what is the depth of this confidence, right? What is the depth of this purchasing decision?
No doubt, ready properties are definitely going off the shelf. But having said that, the new launches that we have done recently, all of them have met with extremely good response. And I think that shows the confidence of the customer that, yes, if I commit myself, my product will be delivered, my home will be delivered. And then again, the advantage is they can pay in installments. They can pay as the construction goes on. So they have that luxury of, committing something today and paying it over the next 3 years to 4 years. So that confidence is there. But then again, the confidence is there for the people who have already have a track record and delivered in the past and have been delivering consistently. It's not across the board. So I think basically, I've said this before, is the karma that you've done earlier catches up with you. And as long as you have a good track record and you have that belief with the customers, you'll still be in business.
Sure. Any more insights, sir, that you can give us that would help us understand, whether this burst of purchases is short-lived, given, some of the incentives you spoke of, right? Like, for instance, in some markets like Mumbai, we've seen a stamp duty reduction. Interest rates are low across the country. Is it short-lived, or do you expect some of this demand, from what you can see, to an experienced eye, that some of this demand has a longer tail?
See, now the momentum has picked up. The products on offer are quite good, and I think the demand should sustain, unless then again this suddenly something goes wrong and there's another lockdown or something like that. But that can't, I mean, that is unpredictable. But having said that, if things being equal, if things go on, if we are able to, sort of keep on going on with our work, with our construction, we have to keep our laborers safe. We have to see that that keeps going on. I believe if all things being equal, this demand will sustain. It will continue. Okay. I don't see any reason for any sort of concern on this. Having said that, yes, if there are job losses and things like that, that could change the scenario very quickly. So I think it's a balance that we have to go with.
Yeah, sure. We caveat all our conversations, not knowing what the future will hold in these pandemic times. But the picture's not so pretty on the commercial real estate front, sir. From what I can understand, there continues to be dramatic stress on malls. Hospitality is only just opening up. Can you give us a very quick view on how you see the next 3 to 6 months pan out for commercial real estate?
Yeah, now you've actually covered this nicely. There are 3 segments in this. You have the hospitality, you have the retail as in malls, and then you also have the office.
Office
now,
spaces.
Yes, and as far as hospitality is concerned, it's just now trying to limp back a bit. Mm-hmm. And I believe that this will take probably another year till the international travel doesn't start. Right. Slowly, yes, business is picking up. The food and beverage business is going on well. A bit of events are happening. Again, you have the limitation of 100 or 200 guests. But people are picking up that courage. I mean, they can't see, a human being is a social animal. They want to get out. So the food and beverage business is picked up nicely, where they are going to places where they are safe, where they feel it's safe. I mean, it can never be always fully safe. Then you have the events happening. I don't think conferences and all that will come back very soon. And international travel, once it picks up, then hospitality will again see its peak. But that is, I would give it at least 9 months to a year, not before that.
What now, about as far malls?
As malls, yes. Now, coming to malls, and that's a happy sign. We just gone through a festival season, and that's where I was also monitoring it. Like to like, we've been comparing figures from last year, the same season, to this year, the same season. And I'm happy to say, in spite of cinemas not being fully functional because there's no software and things like that, and of course, entertainment in terms of all the gaming and other things is still low key. But the shopping as such, we've touched about 80-85% sales compared to last year, which I would say it's amazing. The footfalls are now there, and the footfalls are real footfalls. People are coming, they have a need, they just come in, they spend some time. The coffee shops are doing well, the food courts have picked up. So all in all, in the festival season, there has been a nice spurt. And at 80-85% level, I think we should be happy at this level. And this same thing will continue for at least about a year and a half, when the entire courage comes back, and then everybody feels that they're absolutely safe and cinemas function fully. Because even if cinemas open, I don't know how many people will go and watch a movie and take the risk of getting infected. So that's a stress there. But otherwise, the shopping is on. And
but
people
Mr.
are
Razack, it's
money.
Been a week now since Diwali and the festival season broadly got over. Have footfalls gone back down to, let's say about a month ago levels, or have they remained at slightly sustained higher levels?
they are at sustained higher levels, but now I've compared these figures to say the Diwali season last year to this year. So 80-85% sales have been clocked. Let's wait and watch. I mean, till January middle, there is the festive feel and festive look that keeps happening, and that is something that we need to just monitor very closely. Because we definitely want the retailers to survive, and we want them to do business so that they are also able to afford paying their rents, and it becomes a happy situation. Yes, otherwise, if they don't trade, it's a problem.
Of course,
and that's a real problem. There will be a few vacancies that will happen. Some retailers may really not have the merchandise, they may not have the wherewithal.
So let me ask you a specific question on that, sir. Have you seen a large shift in retail strategy, because many more people are now selling online? So in terms of your, sort of lessors or rentals, are you seeing a large number of vacancies, people pulling out of stores saying, I can no longer afford this? Unless, of course, in most of your malls, you've shifted to a revenue share of some sort.
No. See, again, it's a smaller retailer that needs to be really looked after. Not the branded or the bigger companies. These guys are able to manage. They've got deeper pockets, and they are not going to go anywhere. We'll have to monitor and mentor these smaller retailers, because see, it's a chemistry that happens in a mall. You need to have the bigger brands. You need to have the smaller retailers to bring in the sort of a look and feel into the mall. So it's a mixture of both. And really speaking, if you ask me in terms of how many people are exiting, it's not too many. I think the percentage is below 10. Maybe 7-8% vacancy could happen, and that gets filled up very soon with somebody else. And tell you, I mean, high street shopping, recently we just completed a building, and we've leased it out to 2 large brands, and that's a West Side and Malabar Gold, and they have leased out the store, and one store opened yesterday, and the other larger store is going to open on the 1st of December. So it's not that the larger retailers have given up. While there is caution, they are committing themselves, and they have the confidence that if they go with a bigger owner of a property, at least they know that the support will be there in case there's something that goes horribly wrong.
So you're saying the vacancy levels are not more than 10% across your malls or across the commercial retail properties that you...
Exactly.
Okay, so if I could get a very short, quick summary of how you're seeing the office space business work out as well, because then I do want to get to your Blackstone deal in just a minute.
Yes. Yeah, now there's a lot being said about office, IT offices, work from home. But the fact remains that today, all the tech parks across all the different cities, nobody is going to office. In fact, in a tech park, ideally in a large tech park, where there are almost 50 to 60,000 people working at a time. Today, you go in there, you have about 1,500 people. That they're coming there mostly to see things are all right, maintenance and things like that. So that is the actual scenario on the ground. And people somehow are managing that WFH, work from home, but it's not going to last forever. They have to come back to the offices. They have to start working from there. But I think most of the large companies have given them the leeway to start working from home till, I think, maybe April next year or June next year.
So what is the vacancy level you're seeing in office spaces, Mr. Razack?
Yes, I'll come to that.
Okay,
I'll come to that. So but having said that, there are large take-ups of space also. There are a lot of RFPs that are getting floated. A lot of requirements are coming up. So that's giving us the confidence. And this is not going to be a scenario forever. We have to look at it as a temporary blip that is there. And vacancy-wise, as of now, today, again, as I said, it's in the large tech parks. We have not had many, what I would call termination notices that have come. But if they do come, maybe it's the weaker guys who really could not sustain, or the business is not there. But having said that, in percentage terms, I would say, again, single digit, maybe between 5 to 7%.
Okay.
It won't be more than that.
And these new RFPs that you're referring to, are they coming from the tech industry itself or other industries?
No, it's tech industry. There are many
Tech industry.
companies that are
Okay.
asking for large spaces. They are trying
Okay.
to consolidate on their campuses. Some
Mm-hmm.
are trying to expand. Just yesterday, I read an article saying Wells Fargo in Hyderabad has taken a large space. So similarly, even we've done 2 or 3 large transactions where the take up is going to happen and the rent is going to start very shortly. So
Any big
all of
declines
this.
in rents, sir? Are rentals, moving downwards in many of the key southern markets that you work in?
Now this will be a serious case of demand and supply. As of now, the demand really hasn't sort of gone away. The spaces are still there; they are occupied, and too much supply is not coming into the market.
Because we are
Having
seeing some depression in rentals in key markets like Mumbai. I know that it's really tough for companies like yours to go public with it because it's not a great marketing position to be in
no, no,
to
no,
say
no,
yes, we're reducing rents. But that is
not
that is
like
the
that.
reality
See,
across the board
reduction
with
of
all the
rent
large commercially managed businesses.
reduction of rent did happen in the retail. I mean, we gave rental waiver during lockdown. No, even
That
during
was
the
then,
once
right
we
now.
opened up, yes, in retail also we have given off. I think it's a mixture of revenue share and certain cases we've given 25% off on the rent. Certain cases 50% off on the rents. That is not forever. That's up to December or it'll go up to March. But then it comes back to the normal one because the agreements are in place. Similarly, now in office, I don't see rents going down very quickly, rapidly. They've sustained. Okay, in case the rents were phenomenally high, like you mentioned, Mumbai, they will sort of level up somewhere. It won't go down substantially because even we've got a big stake happening in Mumbai also.
Right.
I think all in all, I am very, very confident that the office market will bounce back. A lot more business will come to India. A lot more tech will come to India. And I think it's not doomsday. It's actually going to be very good, very strong. But only again, the stronger players will
Sure.
survive. And the one-time players will have a bit of a problem.
Yeah, Mr. Razack, I'm sorry to keep interrupting you just in the interest of time because I have so many more questions to ask you. The Blackstone deal, can you talk me through the reasons for it? I know you're using a substantial part of the deal proceeds to retire debt, but is it because, talk me through the impulses or the reasons for why you decided to go through this and the valuation, because the initial report suggested that you might in fact even do a deal for around 2 billion. But from what I can see, you've just done one. Just over one at this point in time, over 9,000 crore rupees.
You see that there's a lot of speculation in the media about the size of the deal, the type of assets, the quantity of assets, and all of it. But now it's in the open space. You've seen which are the assets that are part of the deal. It's all in the public space now. And
Yeah.
you know the size of the deal, it's about $1.2, $1.3 billion. The thing is, it's not about, see, the first thing I'd like to say is there was no pressure from the company at any point of time, whatsoever, to, sort of retire debt or anything like that. And it started off as a conversation, and we were also looking at various options, including a REIT. The whole idea was to see how we can monetize certain assets, a few assets, so that since we were also having a lot of growth that was taking place, and there was no sense in keeping on adding more and more debt and more
Sure.
capex projects were coming up. So we had to do a mix and match of both. We kept certain assets which we felt that were brand new and which we should, keep it as part of the company's asset base, and whichever assets we felt that we could, sort of create, like in the retail now. We said, okay, if you want to pick up all my retail assets, and there were 9 of them, big and small, and it was totally 7 million square feet. Now, parallelly, we are also building another 7 million square feet. In the next year, we'll have a couple of million. In the next 3 years, we'll be back to the 7 million square feet, maybe more. So we are in the business of building, selling, building, renting, building, managing, keeping it. We have retained our Forum brand with ourselves. But it was a sort of a decision where we said it's time for us to monetize certain assets. And then at least we also know the value and worth that, and there was an opportunity We got a fair deal, I suppose, both for the buyer as well as for the seller. And we move on. Then you see, it's also part of, I would say, a move to make the company stronger. And
Sure.
it
So I have
wasn't
a
any
quick
sort of a desperate
sub-question. Yeah,
attempt
why Blackstone and
whatsoever.
why not a REIT? Why Blackstone and why not a REIT yourself?
You know, it could have easily been a REIT. There's no doubt about it. In
Right.
fact, initially with Blackstone themselves, we had a conversation that we combine their retail assets along with our retail assets and then take it to a REIT. But one led to the other, and it just happened. And we have no regrets for it. In fact, we are pretty happy that we'll be cash surplus. This cash, what will happen is the debt against these assets will anyway disappear. And the additional cash that we do get will be used to replenish and create more assets, and will be lighter on the liability side. And that, I think, will make the company much more stronger. And always there is that small percentage which you say could be a risk or whatever. We don't know. The scenario is absolutely not clear. So we probably will be on a safer path than anybody else.
Okay, fair enough. One last question. I believe the roughly 3,700 crore from that proceeds that you're not using towards debt retirement, you're using for new projects, both residential and commercial. I think you're starting work in Bandra complex in Mumbai, the Mahalakshmi Mumbai commercial office from the fourth quarter of this financial year. Also developing new housing projects in Bengaluru, Goa, Hyderabad, roughly 2,000 crores invested there. My question is not specific to the number of projects you're doing. Is your strategy over the course of the next 2 or 3 years of how much you deploy in residential versus commercial, has that changed dramatically post-pandemic, given the new demand impulses in the market? And can you talk us through that?
Yeah, now, firstly, I don't think we need any additional cash for our residential projects because residential is self-sustaining. We do pre-sales. I've always said this, and I maintain this even now, unless you're buying some very, very large piece of land, and that's an initial investment that you have to do. And for that, I think we also have some PE deals where a partner also will invest with us in the land itself, like we've got the HDFC platform. Now, in residential, honestly, we have no business to have any large debt, and we should not also because we are doing pre-sales. Unless any project is bombed and there are no sales, and we still have to complete it. So it's the additional money that's required. The capital really goes into all these large either retail malls or IT parks which you're keeping for renting it out, or hospitality assets. Now, I don't think the company is going to do too many hospitality assets going along. But certainly we are pretty strong and bullish on the office part as well as on retail. We have not lost confidence in both these assets, and this will definitely be the strategy ahead. And I would say we are replenishing our existing assets with newer and more probably a much better look and feel, and a much better location. And also giving that additional value to the entire company's base. So I think that's the whole strategy. And that, again, what it does is the debt component will be less, the equity will be more. I won't say it will be 100% equity, that's being foolish. So it will be a fairly good mix between debt and equity. And that will be like a strategic push once again to take off from there. It will be a platform to grow better.
All right, I understand that. So thank you so much for your time and talking us through the various aspects of the real estate market. Appreciate you joining us here on BloombergQuint. Irfan Razack there of Prestige Estates, talking you through both the real estate market, commercial and residential, and the Blackstone deal that his company is just concluding.
Thanks, Pinaka. Thanks so much. Lovely talking to you.
Thank you very much.